Good morning, everyone. Welcome to this update for global stocks and commodities for the 9th of June. Well, last weekend, things looked reasonably negative. The market had been selling off reasonably firmly, and sentiment was looking like it had shifted. And there was also quite a lot of economic data points that were, providing the right sort of backdrop to that, to what we were seeing in the market. But what a difference a week makes. And so this week this video is about the US Fed. Now, they haven't actually cut rates yet, but they certainly are making noises like they were going to. And then we got a labour report on Friday night that was quite weaker than expected. And so that really just reinforces what the Fed was already foreshadowing that they might do already. So it's yet another example, as we've seen for the last decade, of central banks basically moving to hold up the market. And there's really no other way to dress it up than that. And from a long-term point of view, that's obviously not sustainable, but it is sustainable within time periods that are fine for most investors and traders. And we've seen that over the last decade. So that's what this weekend video is about. Really, the labour report on Friday night reinforcing what Powell had already said. So again, we're seeing central banks, and certainly in Europe, the same thing's happening, where central banks seem as though they're getting closer and closer to a point of zero interest rates. We're virtually there in Europe. And America certainly heading back in that direction, and even Australia also with our rate cut, probably at least one more to come this year, maybe two, which would get us down under 1%. And now the talk of the Australian government needing to actually put additional stimulus in, rate cuts not being enough. So, we're seeing this all around the world. I'll be looking at the normal stock and commodity trend update, and Portfolio Analyst last week I covered a really important topic, and that was what we can control in the market, because things were looking fairly bleak at the time, and a lot of people were nervous. And so that, notwithstanding the rebound, that is still valid because, pardon me, I think I'm just getting a little touch of the flu. So what we can control is what we need to focus on, and that's what I spent some time on in Portfolio Analyst last week. Now, American stocks, big rebound, and they ended up gaining 4.4% for the week, which was the best week that we've seen this year. And this is what I said last week. Whilst things looked fairly doom and gloom, what we don't know is the extent of the central bank response. And, we've seen that. The Fed, without doing so, has certainly put rate cuts now on the table. So in December, we were in full-on tightening mode. There were going to be more rate rises. The reduction in the Fed balance sheet was going to continue, and markets got really, really scared by that. So we've now seen a complete capitulation of that situation. Now, the threats and the slow economic growth that I talked about last week are still there. They haven't changed. They haven't gone away at all. But investors are now back into that mode again, that they feel that the Fed and the other central banks are going to protect them, that they've got their back. And, that's good in the short term, but it's really quite dangerous, I think, in the longer term. So the question to my mind is that a temporary shift in sentiment, or is it going to go on for a bit longer? That's the question we don't know. Now, the US dollar fell fairly sharply on the Fed comments. The 10-year Treasury yield fell even further and looks like it could break 2% fairly soon. So the bond market is still saying that there's a recession ahead. That's what the bond market signals are clearly stating. Confusing the picture a little bit, though, is the junk bond ETF HYG, which I showed last week. Now that recovered quite sharply, so that was looking in danger of a really nasty breakdown. So it's a very confusing picture, I must say. So let's take a look at the US stocks, and we'll start with the S&P, and you can see here is Monday's session. So we gapped down a little bit, found a little bit of support, and then the Fed comments came at the end of Monday's session, and look at the rest of the week. The market just charged back up again. Now, I don't know if that's sustainable. I don't know if we're going to go on and create new highs. I know there's still a fair bit of danger out there because there's no question that global growth is being impacted, and the US labour report, whilst it's only one number, certainly is a sign in the wrong direction, because the US economy, I've been saying for the last 12 months, is strong enough. Well, my confidence level around that is now not quite as high as it was. So I still think some caution is warranted, but certainly investors have been reminded once again that central banks have got their back, and that the most important thing for central banks is the health of the stock market. So that's pretty clear and simple. Let's look at the US dollar. So quite a sharp move, as you can see, in the US dollar, but still the trend is up. We've just come down to the bottom of this trend channel, so no real change there. We're still trending. It's still an overall upward trend in that particular currency. Let's just look at HYG. So you can see we did get a breakdown in the junk bonds, indicating that there was a lot of credit stress in the market. But we've had a very sharp rebound, as you can see, back to 86. So that's the US market. Turning to Australian stocks, the Aussie dollar gained a little, just a tick under 70 cents with the rebound, with the fall in the US dollar. But I did note that the Australian dollar rose by less than the US dollar fell. So we're still feeling the effects here of the rate cut, with interest rate expectations for further cuts, keeping the pressure on the Australian dollar. Plus also the iron ore price came off a fair bit as well. So that helped dampen the Australian dollar. Now our index rebounded by 47 points. But as I've been saying, I think the top 50 is mostly fully valued, and they've got limited growth prospects. So I really just don't see that as a good risk-reward area of the Australian market. Buying meaningful dips remains the fundamental approach in my view. So let's just jump in and check on the on the Australian dollar. On the Australian dollar. FXA, so you can see we've had a breakdown from the 70 cent area. We got down to 68.6, and then we've had a rebound to 70 cents, really on the US dollar fall. Moving on now to the ASX 200. You can see we had quite a decent finish to the week, and I would imagine that the market will go up further on Monday as well. Now, just while I'm here, let's look at the US dollar gold price. So US dollar gold has moved back up to 1340. We've now closed above these highs in February. We've still got to get above 1380, but it's certainly looking better. And if we go and look at GDX, then you can see we've got this declining trend line there, which GDX looks poised on a weekly basis to perhaps move ahead of. So just to confirm there, so gold up to 1341, very strong week, and the Australian dollar gold price went up further to 19.15, and precious metals stocks, GDX advanced to that important support, and local gold stocks, they had a strong week last week, and I think more coming. That's what I wrote last week, and I think the same thing is going to apply in this week as well. Turning to commodities, copper steady at 262. Should have risen more based on the currency moves, but it didn't. So there is still the economic downward pressure on copper. Crude oil gained a little bit, not too much. And again, even the lower US dollar didn't help crude oil that much. And if we look at the if we look at the energy stock ETF, XLE, it's still lagging the rest of the market. So we'll just take a quick look at that one. So there's XLE. You can see that the 200-day moving average is pointing downwards slowly, but the index is below that 200-day moving average most of the time. So we're in a very mild downtrend as far as energy stocks go. So it's not really an area, I think, that offers much in the way of opportunity. There's the spot copper chart. Slight upward tick, but not much. And there's the inventory levels have risen, of course, over the last few months. There's crude oil back up to 54, but I would have expected higher had this been a more meaningful move in the energy sector. So to wrap it up, I think investors, judging by the way they responded in the market last week, certainly feels back on safe ground again now that the central banks have got their back. Sentiment readings were so low that what we saw last Monday could be a meaningful bottom in the market. I'm not totally confident about that, but certainly sentiment readings were as low as they've been in nearly 5 years. So that's often where you see a meaningful bottom start to be created. So this is, I still think there's dangers out there. It's not a time to get sloppy in what you do. You know, don't stumble into any old stock at a certain price because you think the market is now guaranteed to go up, because I don't think it is. So it's certainly not a time to be complacent. You've got to continue to focus on where the risks are minimal and where the upside looks highly likely. There's certainly some terrific opportunities in the Australian market for that, but also in the US market as well. The only reservation that I have is that I wonder at some point, with the Fed now having to stop raising interest rates at a much lower level than has ever happened before, they've now had to stop winding back their balance sheet, and it seems pretty obvious now that the central banks have got less and less impact on bringing the economy back to its normal cyclical position. And I wonder if that big picture penny is going to start to drop with investors, that this perhaps is a spiral that's not going to end well. I don't know. It's hard to tell, because we are really focusing on investor sentiment, and that's a very changeable entity. But I think it's longer term, it's a bit of a worrying picture that is unfolding. But look, for now, markets are back in the upward trajectory, and this could continue for years yet, with central banks doing what they're doing. So certainly worth participating in the market. You've just got to be, I think, a bit more conservative and a bit more cautious in how you do it. Portfolio analyst this week, I'm going to be looking especially for near-term opportunities in the top 300 in Australia. And also, I've been having discussions and getting questions with members about how to manage stocks that over a period of several years can deliver what's called a 10-bag, or a tenfold increase in the share price and greater. And look, there's always those, even in bear markets, there are stocks that still go up by many times their original value. And so it's a question of whether you want to try and trade in and out of these and put up with all the ups and downs in the middle, or whether you just want to take a longer term position, give a stock a few years, and let it see where it can go. There's pluses and minuses to both those methods, so I'm going to be talking about that in Portfolio Analyst this week. There's my contact details for any members for any non-members of that are watching this video, and I'll be back with you next week, and hopefully this little bit of flu that seems to be building will pass, and I'll be a little bit more coherent next week. So that's it for this week. Cheers.